Hi everybody, it's Peter Schiff, and it is Monday evening, July 12th, 2010. And I apologize for not making one of these video blogs in a while. I've been very busy with my Senate campaign. Also, I was in Las Vegas for Freedom Fest and just had a very busy schedule and wasn't really able to sit down and record any of my economic or market commentary. But I thought I would opine a little bit this evening and then get back into the swing. Fortunately, I guess there hasn't really been a lot of major events in the past week or so in the financial markets. It's kind of been, I think, maybe a lull before the next storm, particularly with the U.S. dollar. As I mentioned before, I think to me it looks like the dollar is finally finished its bear market rally. The dollar index is trading just above 84. I think if it closes below 83, that will be very decisive technically. I still believe that that is what's likely to happen, especially given the fact that it seems to me that the world is starting to refocus its attention on the U.S. economy and not so much the European economies, focusing on the fact that the stimulus hasn't worked, that it simply has succeeded in bringing us deeper into debt. We stimulated car sales and home sales, but now no one's buying cars and no one's buying homes, and we're running out of stimulus. Everybody now is talking about the double dip or whether it's going to be a depression. So more and more people are starting to lose faith that the stimulus is going to succeed. Now, I always knew that it would fail, but there was widespread belief that maybe it wouldn't, and that when it came to the lesser of the two evils, that as bad as things were in America, they were a whole lot worse in Europe. Well, now people are starting to rethink that conclusion and thinking, maybe Europe is getting their act together, but there are still a lot of issues in the United States that are unresolved. One thing that happened today that I think is very interesting, I'm not really sure how the press is covering it because I haven't had an opportunity to watch today, but there was a credit agency in China that came out with its bond ratings for sovereign debt. And it rated the U.S., I think, as AA with a negative watch. So not nearly as high as S&P and Moody's. In fact, the agency rated China debt much safer than U.S. debt. I think the U.S. came in at number 13 of all the countries, meaning that there were 12 other nations that this rating agency thought were more creditworthy than the United States. Of course, our agencies, S&P and Moody's, they rate China 4 notches below the U.S. U.S. has got the top AAA rating. Now, of course, these are the same agencies that rated subprime mortgages AAA right before they collapsed. So, it's hard to say they actually know what they're doing. In fact, I think that since these companies enjoy exclusive duopolies basically granted by the U.S. government, there's probably a lot of pressure on S&P or Moody's not to downgrade U.S. government debt, even though it should have been downgraded a long time ago. But think about it logically. Why should our debt be safer than China's debt? After all, our government has debt. China's government does not. I mean, yes, Chinese government issues bonds, but that's against $2.5 trillion worth of reserves. Their liabilities pale in comparison to their assets. In the United States, our foreign reserves, I think, total about $50 billion. Our liabilities are $13 trillion, and that's just to fund it. It's not the off-budget or the contingency. So we are actually deeply in debt. China is not. I mean, how is it that China could default? I mean, first they would have to blow through all their foreign exchange reserves before they defaulted. They would have to cash in $1 trillion that we owe them. I mean, there is no sane method that would lead you to believe that a world's biggest creditor is somehow less creditworthy than the world's biggest debtor. I mean, if anyone is likely to default, it's the United States. It's not China. I mean, why would they? They don't have to. Now, of course, we might not default, but we'll inflate, because we certainly don't have the money to pay back our creditors unless we print it. China doesn't have that problem. They got $2.5 trillion in reserves. They don't have to print anything. They can pay off their debt many, many times over. So the whole thing is absurd. But the fact is, the emperor's new clothes, sometimes somebody says something and a light bulb goes off. Now, maybe other rating agencies around the world will take notice of this difference. And of course, obviously, in China, I'm sure this is significant, and all the various sovereign wealth funds, not just, the Chinese government has its funds, but you also have the provinces, and they've got their own sovereign wealth funds. So I think this is an important shot across the bow here that people should take notice of and not simply dismiss it as, oh, it's all propaganda, oh, it's rigged, oh, sure, China just rated their own debt higher than, there is a reason for this. There is method to this madness. It's not madness at all. It makes perfect sense. Also today I was reading some warnings coming out, I think, of the Bank of International Settlement and some other European banks, not only about the problems with the sovereigns, but corporations and banks. They noticed that debt right now, the maturity is the lowest in 30 years, the average maturity, especially among banks, that they have been borrowing money just like the U.S. government with very, very short maturities. Now, the reason for this is because the lenders aren't going to lend long-term with these low rates. Somebody might be willing to loan me money for a year for 2 or 3 or 4%, but they're not dumb enough to do it for 30 years because they don't want to take the interest rate risk. See, if you loan somebody money for 30 years, if you buy a 30-year government bond or a corporate bond, or if you take out a 30-year, or if you're a bank and you sell a mortgage, 30-year mortgage, if interest rates go up, it's the lender's problem, right? The lender, the person who loaned the money, if I loan money and I'm only getting 4%, let's say, and then interest rates go to 10%, and I'm stuck with a 4% coupon for 30 years, so the risk is on the lender, right? But when it's a short-term debt, the risk shifts to the borrower because now the borrower is in trouble. And so think about it from the perspective of the mortgage. If I take out a 30-year mortgage and I lock in my rate for 30 years and the bank loaned me money for 30 years, and if interest rates go way up, the bank loses because I've got this low mortgage and rates are a lot higher. If they can sucker me into an adjustable rate mortgage, then if interest rates go up, it's my problem, not the bank's. Now, of course, if the bank was dumb enough not to require a down payment, well, then it's their problem again because I just stick them with the house. But that's what's happening with the banks. The banks are borrowing money for 1 or 2 or 3 years because the lenders don't want the interest rate risk. They are transferring it to the borrowers. So what this article is pointing out is that over the next year or two, all this short-term debt is going to mature. And what if the lenders don't want to roll it over? What if they want to do something else with the money? Or what if they demand higher rates of interest? That this is going to be a major, major problem with all these banks and all these governments all around the world competing for that rollover money because none of them had the intelligence or the foresight to lock in low rates for 10 or 20 or 30 years. And the reason they did that, the reason they made that mistake, it's the same reason that people took out adjustable rate mortgages that should have taken out 30-year fixed. Because the trade-off is, in the short run, you get a low interest rate. The trade-off is you assume all this risk in case interest rates go up. And for a lot of these financial institutions and governments, when you're dealing with shareholder money or taxpayer money, they didn't care. All they cared about is they can pad their earnings or make their deficits not look as bad if they took advantage of all this cheap money, but put the big increase in interest rates. We'll leave that to their successor. I'll leave that after the next election. All of these chickens are coming home to roost over the next few years. And if I believe, as I'm correct, interest rates are going to rise. Why are they going to rise? Either two things are going to happen. Either the economies are going to grow and interest rates are going to go up because of all that extra demand, and or we're not going to get any growth and we're going to get more stimulus and bigger budget deficits, which is going to create more inflation and weaken demand. So no matter what happens, if you believe that the economies are going to recover or if you believe they're going to collapse, either way is going to lead to higher interest rates, and that is the problem. It's a problem for governments, it's a problem for banks, it's a problem for corporations, and of course it's a problem for their shareholders, or if you're a taxpayer or you hold any of these currencies like the dollar that are likely to be debased. Anyway, that's it for today. We'll see if we get any actual market moving news in the next few days, and if we have any, I will be sure to comment on it. Take care, everybody.